So I saw a few minutes ago that for the sixth time, evidently the Senate has failed to reach consensus to reopen the government. Okay, so we're going into second week of the shutdown. Leave your thoughts and comments below. When do we start seeing trash pile up on city streets? When do we see services start being cut and this having a real impact? I say it because, again, today, the S&P 500 and the NASDAQ closed at fresh all-time highs, okay? Dow was flat, but the markets are still shrugging off let's say the potential likelihood at this point of a much longer shutdown. But obviously the story today I want to discuss with you from a little different perspective than you're hearing. I think the story of the day is gold. Gold is at an all-time high. It blew through $4,000 an ounce last night. It's holding it so far today. Silver's doing really well. It also blew through the $49 level. It's kind of treading water right now around $49 just before the metals markets close. But it's not just me sitting here telling you, go out and buy gold. You got to have gold. The sky's falling. Go get your silver. Obviously, you guys have all got to decide whether that makes sense for you and with your individual situation, right? But what I want to share with you is what this means on a more of a macro level, okay, from the perspective of foreign central banks, okay, and from the perspective of the U.S. investors and gold ETFs. I'm going to show you several charts today that hopefully will drive the point home. Before I jump into it, as I always humbly ask, if you have not subscribe to the channel, I would really appreciate you doing that so we can keep growing the community. So let me start with a chart I just saw about an hour ago. It was put out by the Visual Capitalist, to give credit where credit's due, from Tavi Costa at Crescat Capital LLC. So I want to show you this this chart, okay? Because I think it is important that you see this. And let me see, can you guys get that back there? I know it's probably a little small the further I move it back from the camera. But what this shows is foreign central bank reserves, okay? And what it says is for the first time, okay, since 1996, foreign central banks are holding a greater share of gold in their reserves than they are U.S. Treasuries. Now this goes back over here, 1970. But you go here, 1996, here's present day. 1996 was when this all flipped, right? And the gold holdings started, let's say, falling below the amount of U.S. Treasuries or U.S. debt that foreign central banks were holding on their books as a percentage of their international reserves. But that has all changed over here now. Looky here, okay? We got to go back 30 years, which is this span of time right here, okay? From 1996 to almost 2026, right? To the last point when the gold reserves were larger than U.S. Treasuries. What does that mean? It means that foreign central banks are running from the U.S. dollar, all right? It means that they are running into gold and they are making that a primary holding, okay, as a percentage, okay? So what we have is obviously U.S. debt concerns. As the U.S. national debt grows, as they sit and look at what's going on with our government right now, you think countries around the world are not watching everything that we're doing wrong, with our currency and with the reserve currency and with fiat? Absolutely, and now we have a government shutdown, okay? So they are looking at debt concerns, geopolitical risks obviously around the globe, and confidence in the dollar continues to weaken, okay? So I would not expect to see this trend change anytime soon. I'm going to share a story with you relative to some comments made by Goldman Sachs in the last few days, not only about what they expect the gold price to go up to in the next year, but the reasons behind it, okay? So that, I thought, was a very, painted a very clear picture of what's going on with foreign central bank gold holdings in relation to their U.S. debt holdings. And it's important that I wanted to show you that, because out of Zero Hedge this afternoon, a story comes out just a little while ago saying yields jump after 10-year ugly auction, after ugly 10-year auction tails, foreign demand tumbles. Okay, and the article on Zero Hedge again says, after yesterday's ugly 3-year auction, moments ago the Treasuries sold $39 billion in 10-year paper, okay, debt, and the reception was again rather disappointing. It says the indirect bidders, those are the foreign bidders, all right, plunged from 83.1% to 66.8%. Okay, that's well below the 6 auction average of 73.7%. So today we have foreign bidders showing up at a much lower percentage, okay, than they have, say traditionally. So they are, again, I'm definitely, I may be putting in the wrong terminology. I'm definitely not a expert on U.S. bonds or treasuries or debt. But what this basically says in plain English is that the foreign bidders are drying up, okay? They are shunning U.S. debt. And I would say probably, for good reason. So again, back to this chart, right? Why would we see this trend, okay, on this side change anytime soon? I bet we do not. Leave your thoughts and comments. So the next article I want to share with you, also on the Zero Hedge, and several news outlets covered it. I've got one sitting on my desk from Kitco. It's all over the news about Goldman Sachs coming out and saying, yes, they expect gold now. They've revised their price target for gold from $4,000 to from $4,300 an ounce to $4,900 an ounce. And what they're saying is it's probably going to even be much higher than that. So out of Hedge today, gold has just topped 4,000 per ounce level for the first time ever, cementing its status as the year's best performing asset and most intriguing story in global commodities, not to mention the most important themes across broader financial markets. One of the accelerating and relentless fiat destruction, coupled with what Rabobank earlier called passing the global fiscal event horizon, okay? And we talk about where gold is now as performing in relation to U.S. stocks. Again, another chart for you today. This was it within this Zero Hedge article. If you guys want to go check it out, and you guys can see that hopefully gold outperforming U.S. stocks and global stocks. Okay. So gold is in the black up top here. Okay, you guys can see that. U.S. stocks, the S&P 500 is in the blue. And then at the bottom in kind of a pinkish is the MSCI World Index. Okay, so granted, a lot of this gains happened this year so far. But look at the outperformance, okay? And why would this stop anytime soon with what's happening on, every front, okay, that I just covered with you? All right, so we're seeing, a massive rally in gold, which is really taking over in terms of the performance of an asset, both the U.S. stock market and the global stock market. All right. So anyway, I'd love to get your thoughts and comments on that, but just, food for thought in terms of, where you guys are allocated and how you're thinking about, your investment strategy. So the article goes on to say the recent restart of the Fed's rate cutting cycle has also been a boon for gold, which benefits at any time the Fed injects liquidity into the system like now, right? Number one, they're causing inflation. Okay, and number two, the opportunity cost of holding gold is less as the interest rates are going to fall or are falling. Investors have responded by piling into exchange-traded funds with bullion-backed ETFs, seeing their biggest monthly inflow in more than 3 years in September, according to Bloomberg. Okay, and here is a chart that was, again, in the article that I want to show you, talks about the spot gold, okay, gold spot versus total gold ETF holdings. Again, another, I think, interesting chart to see. In black is the ETF holdings, okay? That's down here, okay? And in the blue is the spot gold price. Now this chart, when this chart was printed, gold was at $3,574. You can see up top here, guys. Sorry, I'm all over the place here, but that's up top. Gold's a lot higher than that now, right? So ETFs have a long way to go to catch up, all right, compared to where they're at now. And so I think that's something else to just make a mental note about, and we'll have to keep an eye on that. But what these articles are all saying is it may not be a situation where people think it's overbought and run for the hills, but the ETFs, that money may continue to drive up the gold price. So again, back to the story, gold breaking $4,000, it says, isn't just about fear, it's about reallocation, said Charu Chanana, a strategist at Saxo Capital Markets. And this person says, with economic data on pause, all right, because the government shut down, and rate cuts on the horizon, real yields are easing, while AI heavy equities look stretched. Central banks built the base for this rally, but the retail and ETFs are now driving the next leg. Gold's rally is on pace for its best performance since the 1970s, a decade when soaring inflation and the end of the gold standard sparked a 15-fold rally of the precious metal. Ahead of the historic breakout, Goldman this morning, again from today, raised its 2026 gold price forecast from $4,300 to $4,900. And the bank supports its forecast based upon 3 points. The first one, central bank buying, they're saying next year will be an average of 70 to 80 tons. It's 80 tons this year. They think it'll average 70 tons next year. Okay, that's going to contribute to a 19 pp. Okay, so 19 percentage point gain in gold by December of next year. The second, prong is Western ETF holdings. I just showed you a chart. They say it's going to rise as the Fed cuts the funds rate by 100 basis points projected by mid-2026. And Goldman says that's going to contribute to another 5 percentage point gain on the gold price by December of 2026, right? So we have 19 percentage points from foreign banks gobbling it up, 5 points from Western ETFs, and then the last one is speculative positioning to gradually normalize, okay? I'm talking about not just private speculators coming in buying gold, and Goldman is saying that'll be contribute 1 percentage point to the gold price. Therefore, saying that it's going to be up 25% from where it's at right now by December of next year. Again, not financial advice, not trading advice, just sharing with you one of the biggest banks in the world of what they're saying. Elevated central bank buying is a structural shift, it says, in reserve management behavior. I think I just showed you the chart a few minutes ago, and we do not expect a near-term reversal, according to Lena Thomas, Goldman commodity strategist, and she wrote that in a September note. That was September note, right? That was before the recent rally over the last 2 weeks. Our base case assumes that the current trend in central bank accumulation continues for, how long do you think? According to this author, another 3 years at least, okay? So I'll leave it there today. We're a little bit long, but I wanted to show all that with you and show all that to you and try to bring it full circle in terms of the different elements to this story on gold. Okay, it's not just safe haven asset. I mean, I think it's moved beyond that. Okay, it's not just store of value. It's moved beyond that. We're seeing a massive global shift, which now is encompassing, really for the first time, the United States, the U.S. Gold ETFs. And when the investors catch on to this, they'll be the ones lining up down at the pawn shop or the local coin shop, to buy silver coins, and if they can't afford it, buy fractional gold or gold coins when gold's at 4,000, 5,000, 6,000. If you guys are all seeing what I'm seeing out now, many people are out there, not just, let's say pie in the sky theorists, but saying that, gold could easily be topping that $7, $8, $10, $15,000 range. Silver is, once it gets through 50, could easily blow through 100 and thereon. Again, I don't like to, indulge in that stuff too much, but it's definitely, we're seeing the shift. All right. So I appreciate you guys. If you like the content, if you enjoy the content, leave me a like on the video. Subscribe to my channel if you would, please. If you're not subscribed, give me your thoughts and comments. And with that being said, I will talk to all of you soon. Bye.